to our podcast, Production Pioneers. I'm your host, Kevin Durkin, President and CEO of Quant-Tek AI. Today, we're going to go off the rails a little bit from production, manufacturing, and distribution to somebody that actually acquires the firms, an equity firm. So today, I'm thrilled to welcome Eric Wicklund, Managing Director at Speyside Equity, joining us from Ann Arbor, Michigan. Eric brings a unique blend of operational leadership and private equity expertise, having served as president and CEO of Helix Heat Transfer Systems and held progressive roles at industrial giants like Eaton Corporation and Hilti Corporation. At Speyside, he's part of the team that makes an operationally intensive approach to investing in special chemicals, industrials, and food ingredients business. Eric's story is one of transformation, from opening automotive plants in Mexico to leading marketing departments and now helping middle market companies navigate challenges while creating sustainable value. Welcome aboard. Appreciate you being here, Eric.
Thanks a lot for having me today, Kevin. Appreciate it.
I'm looking forward to this. In doing the research, it was pretty interesting. You have quite the career all over. I thought it was wow. You went from industrial sales to CEO to private equity. What drove those big career jumps?
Yeah, so I started my career after Notre Dame back in the Detroit area as a consultant, consulting to middle market manufacturing companies, and I really liked that, but kind of figured out I didn't want to spend the rest of my life changing the world one PowerPoint slide at a time. So I set it as a goal to become a CEO or investor in manufacturing businesses. And then got into doing that by way of going back to grad school at Wharton. And then to your point, working at Eaton and Hilti with the idea of building a operational knowledge of manufacturing companies to really augment the investing in those companies, understanding how value is created and destroyed, in order to buy those sorts of companies and then help them create value by executing the best of what I saw in those companies that I worked at that were bigger. So guys that go into private equity, there's kind of one or two ways to do it. There's kind of the typical way, which is the financial route, and then there's kind of the atypical way, which is more the operational route. And I picked the operational path, but it's a good path, especially for what we do at Speyside, just because there's outsized returns to be generated when you buy a company and then improve it significantly.
So you ran Helix before getting into PE. How different is it running a business versus just analyzing one?
Yeah, it's significantly different, just because when you're doing it from a PE perspective, you're thinking about it from, I guess, multiple aspects. Still think about it from a CEO aspect, having done that, but I also now have to consider our investors they're called limited partners, or you'll hear it referred to as LPs. And then also our economics, we're the general partner or referred to as GP. So a lot of what's happens, or a lot of what's talked about in private equity, you'll hear about is carried interest, and that's how private equity firms make their money. So it's essentially, you'll hear 2 and 20. The concept is 2% fees and 20% carried interest. 20% is essentially the private equity firms get 20% of the deal profit as part of their compensation. So thinking about all those things together is a little bit different than just thinking about it from the perspective of the CEO.
Actually, that was my next question: is how do you evaluate deals today versus from being a CEO? You know, opening a plant in Mexico. How's that hands-on experience help you?
Yeah, it helps quite a bit because from a private equity standpoint, what we like to do at Speyside is we like to buy companies that are underperforming, that are usually in misaligned deals, ownership structures. So we'll buy something where The people that own it, it's kind of underloved and therefore undermanaged and therefore underperforming. And that operational background that I have is very insightful into how we improve those businesses. Generally speaking, we're using what we call our Portco value creation system to take a two-phase approach to creating value. Phase one is operational improvement. That's where we'll take a business that's underperforming industry level EBITDA margin standards and bring it back up to the standard. And then phase two is the growth phase where we'll do bolt-on acquisitions and organic activities to grow the top line such that we end up with more EBITDA and therefore greater equity value when we exit it after a 5 to 7 year hold period. So understanding how that value creation occurs in a company is really, really valuable, and understanding really the potential that the company could have to create value is super duper valuable. And having done it makes that understanding a lot easier to come up with.
I'm sure you have valuation guys and all that, but do you ever look at a deal and say you think it's more valuable than what they think?
Absolutely. So, I mean, if you think about it, at the end of the day, when businesses are transaction being sold, I mean, kind of the joke I always make is that we're more than happy to sell a business when somebody else thinks the present value of the future cash flows is worth more than what we think it is. And that's essentially what's happening in any transaction. It's a bit of game of the joke is it's a bit of game of liar's poker because you as the buyer think it's worth slightly more what the seller thinks, and the seller thinks it's slightly worth slightly less than what you think. And that's how you end up finding that equilibrium, which is oftentimes significantly facilitated by investment bankers. They're looking for, buyers for a business that is has a seller that's looking to sell, and teasing out that value and finding a value where everybody feels like they're getting a good deal is really what they're good at doing.
Awesome. So it's space side, speed side. I apologize. I should have asked that earlier. What's the correct pronunciation?
It is Speyside.
Space.
Speyside is River Spey is a river in Scotland, and the Speyside region is a Scotch whiskey producing
I knew I
area
liked
of
you guys.
Scotland. Yeah. So my one of my partners, Kevin Doherty, who originally founded the firm, his family has some Scottish heritage, and there's kind of an entertaining origin story around Speyside Equity back from 20 years ago when he started up the firm. It was in a situation where he was buying a company from a large publicly traded company that is headquartered in Munich, Germany. And the deal was lubricated up over a couple rounds of scotch late one night in Munich in Bavaria, Germany, and that's why our colors are that periwinkle blue and white. It pays a little bit of homage to the Bavarian flag, and then the name comes from the region where the scotch was produced that lubricated the deal.
Yeah, next to the River Spey.
Yes,
So
sir.
I'm glad I asked. That was probably should have asked that at the beginning, but so SpaceX calls itself an operationally intensive organization. What does that actually mean day to day? What can you give me some feedback on that?
Yeah, what's unique about us, and the reason why we generate really high returns, 5x or greater net MOIC on deals, and top decile returns in the population of other private equity firms, is because we really like to buy things that are operationally underperforming. And so operationally intensive means that our model is such that when we think about how we're going to create value in a deal, it comes a lot from the operational improvement. And what that means is that on average over the last 20 years in the deals that we've done, we've improved EBITDA margins in companies that we've owned on average from 6% to 14%. But you can't just do that by sitting around and being passive. So you got to be active. And we use a very integrated approach to deal making to understand how we're going to improve those EBITDA margins using that system that I talked about before a little bit, the Portco value creation system, using an operating partner model to facilitate it. And what it means is, in especially the first 6 to 18 months of ownership, we are very much looking to execute 3 to 5 deal theses that are very operational in nature that we can very much control and have our operating partners take ownership of and execute and improve the EBITDA margins significantly, and then grow it from there.
Can you describe the Portco operational, whatever you just said again?
Yeah, the Portco value creation system, it's a system that we use that I developed, and uh, to be honest, I took an idea at a company I used to work at called Eaton. We had the Eaton business system there. Eaton took that system really from Danaher, which was the Danaher business system that took it from Toyota, which was the Toyota production system, which took it from Henry Ford way back, in the day. But what the concept is using scalable, repeatable processes through known tools and frameworks
Sure.
to execute improvements in a business. And as I noted, phase one for us is operational improvement, and phase two is commercial growth. And the phase one, the operational improvement for us breaks down into 4 areas of activity. One is management and accountability systems. Two is organizational design and capability. Three is capital efficiency, and four is commercial and go-to-market improvement. And then within those areas, there are sub activities that we execute on, like, for example, in the capital efficiency area, we would do like manufacturing footprint optimization. A lot of the businesses we buy would have like 10 manufacturing plants that are running at sub capacity utilization metrics. So maybe they're at a 28% capacity utilization for those plants, and we'll combine plants so that the capacity utilization goes up. Or we'll do like Salesforce effectiveness activities where we'll think about the things that the sales force is selling and how they're doing that, and then how they're compensated, and maybe give them a greater upside with a better comp structure so that they go out and sell more. Or we'll do spend leverage activities, figuring out how to buy raw materials at better prices or at better terms. And we'll do things like that. And each one of those activities, there's 26 in our model. There's like 18 in the operational improvement phase and 8 in the commercial growth phase. They each have like a well-defined framework and tool set and process that we then use at the portfolio company to improve the EBITDA of that company, and also the EBITDA margin.
Interesting. So you guys target companies with complexity, it says, legal, environmental, labor issues. Why chase problems everybody else runs from?
Yeah, short answer is they're cheaper to buy. And so we're more than happy to do some structuring that around some of those things. But usually what that means is that we can get into deals for a 3 to 6x entry multiple. Whereas like companies that maybe don't have some of those challenges, the entry multiple is higher. But what we'll do is we'll buy those companies and we'll structure around those challenges. And then oftentimes when we go to sell them, we sell them at a higher exit multiple because we fix those issues. It's a lot like flipping houses, what we do, honestly, but there's more zeros and a lot bigger egos that's associated with it. So, similar to like, the concept of curb appeal in flipping of a house. A lot of the businesses we buy that we initially start with don't have a lot of curb appeal because of those complex structures. So
Sure.
we come in and clean those up, and then we also make them more profitable. So it's kind of like, you look at the landscaping of a house that somebody might flip, and that needs to be fixed. That's like fixing the structuring, and then you go inside and put down new floors and paint the walls, and that's the transformation that we do to improve the EBITDA margins. And then when you flip it, it's worth more.
What makes specialty items like chemicals, industrial food ingredients, what makes those sectors attractive?
Yeah, a few reasons. Number one, they usually have, we can find companies in what I would call value added, value engineered niches in those sectors that we really like. There's 8 sectors that we really like, and then 3 that we avoid. We really like metal and metal forming, chemicals, plastics, performance materials, industrial minerals, building products, pulp and paper, glass, and then we try to avoid anything with significant concentration in automotive, oil and gas, or government stroke of the pen risk. The reason being is the ones we like tend to have a nice smooth business curve. It looks like a nice dampened sine wave. Whereas the ones that we don't tend to like, auto, oil and gas, and government, those tend to look more like a business cycle that's the EKG of an angina patient. And we tend to avoid those because you can't plan for those things, and it's a little bit more risky. And the ones that we do like, where they have those value added, value engineered niches that we like to find, they tend to have businesses that are fit our backgrounds, that we know how to create value there. And then they also have collateralizable assets where we can do simple debt structures to start with that are low leverage ratios. So a lot of private equity guys, they do what they call financial engineering, which is figuring out how they can set the leverage ratio or drive the leverage ratio up to 5 to 7 times EBITDA, which is a lot of debt and it's a lot of risk. We jokingly say that the financial engineering we do is to figure out how to buy a company where we can set the leverage ratio at 2 to 3x. And the reason why we do that is that the companies in those sectors, we can buy them at those leverage ratios, and then we can focus more on improving the business in the first 12 to 18 months. And then we can come back and recap the debt structure at a later time. But those those subsectors of manufacturing that we really like tend to have the characteristics where we can execute that transformational plan with low leverage debt structures.
Interesting. Coming in and buying a company isn't just buying a company, it's buying people and the leadership that comes with it. Um, I've noticed that when private equity comes in, there can be and will be turnover at the leadership level. How do you deal with that? What's do you have processes to help along the leadership? Because sometimes those CEOs, and I know because I was it twice, well, 3 times, excuse me, um, we're a little stubborn. Our way's the right way. Do you understand what I'm saying?
Yeah, for sure. So for us, it's important to get alignment of doing what we're going to do. And there's kind of, I guess, intrinsic and extrinsic factors there. We really like to partner with CEOs and management teams that want to do the kind of work that we need to do in the companies that we buy. We're not for everybody, but usually we find the right people that can execute the transformation we're looking to do. And folks that love to do that work, the men and women that like to do that work, they love working with us because uh, myself and my two other partners, we've all been C-level guys in middle market manufacturing companies, and we've all executed startup shutdowns and turnarounds in the middle market. So we understand what it's like to be in that CEO seat, and we understand it's not easy. But the first thing we look for is like the internal inside of you motivation that wants to transform a business and make it better and grow it and drive value creation. And then the second thing, I guess, is more of an extrinsic motivator, which is we give equity LTIPs, long-term incentive plans, to key management team members. But what we explain is that those LTIPs vest based on value creation versus time. And people have to sign up for that, and they have to kind of be aligned with the key 3 to 5 deal theses that are going to create the value. So we really like to partner with CEOs and management teams that really like to do transformational work and are excited about doing it because they can create generational wealth through their equity L tips if it goes according to plan.
Yeah.
As a result, it tends to work pretty well to get, pretty well aligned. And again, usually the companies we're buying are underperforming when we're buying them. So to your point, we've definitely seen some CEOs where, it's kind of my way is the highway, or they have a little bit of a healthier ego than the average person. But usually when a business is underperforming, people tend to subjugate their ego to wanting to do a good job. And we're honestly not big ego guys ourselves, because again, we understand what that's like, and it's hard, and you can't. It's never going to go perfectly. So we're very understanding of that, but we want it to be going directionally correct.
Yeah.
And yeah, finding good people to work with is definitely, an important thing in what we do, because human capital is a very important input factor into value creation in private equity and a sport, especially the transformational private equity that we do.
Yeah. I always found that I like the inquisitive people, the people that are willing to learn and try and open to new things. Those were my faves. You just closed $620 million fund. How do you stay hands on with that much more capital?
Yeah, so for us, it's using the operating partner structure and also making sure we have good management teams. And again, back to that systematic approach, the big reason why we've spent a lot of time building that and setting it up in a systematic, process-driven way with tools and frameworks is so that we don't have to reinvent the wheel on those things. So it's really about scalable, repeatable processes that continue to deliver outperformance, fueled by human capital, like we just talked about. And that to us, that's the magic. How it gets done, that's the process, how work is achieved. And then, of course, finding the right deals to execute that on is really, really critical, because not all deals fit for what we do. We got to find the right deals with the right characteristics for it to be worthwhile for all parties involved.
Well, thank you for walking into my next question, which is how do you find these complex deals
Yeah,
that
it's
and that and really and that others avoid? That's really what.
yeah, yeah, it's a good question. And so I took probably too many art classes in high school. So I really like to plagiarize a quote from Michelangelo for this. And what I like to say is his quote, which was that I saw the angel in the marble, and it was my job to carve until I set it free. And a little bit what we're doing is, I think about that. There's a lot of art in what we do in our deals. And, we're looking for the right potential portcos that where there's an angel in the marble. And for us, an angel in the marble means a 5x net MOIC deal or better, meaning that you give us $1 of your money, and we're giving you in 5 to 7 years $5 back. So we're trying to, quintuple your money over 5 to 7 years. And finding the right deals to do that with is it's not easy. And we have a screening methodology that we use, and then we work with various sources to finding those deals. Sometimes it's banks and intermediaries. Sometimes it's professional services firms. Sometimes it's just our reputation. Sometimes people will literally just call us, or sometimes we'll just call them and ask them if they want to sell a company. Sometimes we're talking to other bigger funds that, they have some orphaned asset or a long-owned asset, or sometimes there's companies out there that are public that should be private that we can buy. Sometimes companies have too much debt and we can buy the debt and get to the equity that way. Or sometimes it's corporate carve-outs where, it's a large conglomeration, multi-billion dollar multinational corporation that has an orphan division that, just doesn't fit with their strategy anymore. So those are the kinds of things we're looking for. We really like things that, have the potential to be an angel, i.e., they have the ability to improve their EBITDA, but tend to be in misaligned ownership structures so that they're underloved. Therefore, they're undermanaged, therefore, they're underperforming, but they're good base businesses. We call it value investing. All of us are at SpaceSide are huge fans of Warren Buffett and, his models. And we just apply a lot of his concepts, his value investing concepts to deals that are underperforming, but in a private setting versus a public setting.
An acquisition of deals, or the finding of deals. Do you ever run into the troughs, the highs and the lows of? Does it ever slow deals coming in? Is it fairly consistent?
It's fairly consistent, and the reason why is that really what we're looking to buy are 100 million to 500 million dollar revenue businesses that are manufacturing businesses that are in US and Canada that are underperforming,
Hmm.
and there's no lack of underperforming middle market manufacturing businesses, especially you could even say we're lower middle market at 100 million to 500 million, 500 million. So there's always something you can do to improve a business, some more than others. And it's kind of surprising. Everybody thinks that we end up with way more deal flow in the trough, but it's actually really pretty consistent. I would say, like, for us, where peak to trough in the economy might be a lot bigger. Our peak to trough in terms of deal flow is probably just plus or minus 10% in good times versus bad times.
Hmm. Do you ever miss being a CEO, or do you like what you're doing?
Great question. Sometimes yes. And I really I love leading. I love coaching. So I miss that part. I coach a lot of our CEOs at our portco, so I get to do that. But that's a little bit of a different, coaching than it is coaching, a team or leading a bigger team. So at times I miss it. There's parts I love about, both sides of the house. Like investing is super fun, and leading a business as a CEO is super fun. And yeah, sometimes I kind of wonder what the best of is of those two jobs, because I've loved them both. And it's hard to say one's better than the other. They're just a little bit different, and it's slightly different skill sets and different sorts of rewards.
Interesting. I'm going to jump into leadership and investment strategy, but I do have one quick question. The person we were talking about earlier, Jim, he does what you do in a different industry, but he had to take over as temporary CEO. Have you ever done something like that for a company?
Yes. Yeah, or jumped in and run something for a bit of time until we could backfill somebody. That was earlier in my career at Speyside. Nowadays, I probably wouldn't do that. We hire operating partners and have a pretty deep roster of those folks. But in the past, we we had done that or have done that, but that was yeah, probably 10 or 12 years ago now at this point.
Okay. Notre Dame, Wharton are great, but real education was running companies. How do you evaluate management teams?
Yeah, so I have a model that I use in terms of managing. There's two parts of that. There's kind of psychology and sociology. So the one part is analyzing individual people, and then that's the psychology, I guess you would argue. And the sociology is how do they fit together as a team, and how are they going to play nice in the sandbox together. From an individual analysis of people, I've always used kind of a specific model that I have developed over the years. I call it the Q cubed model, which is IQ, EQ, AQ, and CQ. Now I would add a fifth Q based on the discussion I had with a buddy of mine that I really like. But the first four, so IQ is as it sounds, intelligence quotient, right? You just want to know that people are just reasonably intelligent and have enough
More,
intellectual, yeah, just a certain amount of intellectual horsepower.
yep,
But that's not good enough, right? Like that's great that you can be really smart, but you also people need to be able to work with other people and therefore have pretty decent EQ,
yep,
which is emotional quotient. And that's all well and good. You can be smart and you could be really good at working with people, but there's a third Q, which I call AQ, which is adversity quotient, which is the title of a book that a guy at University of Pennsylvania, he's a psychology professor, wrote. And essentially, I'm paraphrasing 300 pages, but what he argued in the book that I think is true is that there's lots of people that are smart, lots of people that are good with people, but when you pare it down based on people that get stuff done and are willing to deal with adversity, i.e., they get knocked down, but they get back up and keep trying, you come up with when you do the Venn diagram, you come up with a much smaller set of people. And I think that's a very important thing is, especially in what we're doing, the people we like to hire in our investment team and as operating partners and in our management teams, we know that we're doing transformations. They're not going to be easy. So you got to have a certain amount of adversity quotient. You can't just quit because something's difficult. So we care about that as well. And then the fourth Q is what I would call the creative quotient. And there's if you think about IQ measures like analytical, convergent thinking. The creative quotient is more like divergent thinking and synthetic thinking. So, describe more simply, analysis or analytical thinking is how do you break a problem apart and get to an answer, whereas synthetic thinking is how do you take different concepts and put them together to come up with a whole new whole, right? And it's interesting because you can see people that like can do differential calculus in their head, but like if you ask them to come up with a good idea or a new idea, like they struggle with that because they're not very creative. And what we want are people that are like good at all of those things, right? And then my buddy, his name's Jeff Hackala, he runs Clarkston Capital. He came up with I was telling him this model a few weeks ago, and he said, I think there's a fifth one. And
hmm,
he named it enthusiasm quotient, which I think is right. And what he was saying is, he's like, look, you got to have people that want to be there because like they like what they're doing. And I really like, and he went on to express this in a longer form, and he's a brilliant guy, and it was a brilliant idea. And I was like, he's right. It's you really want to find people that they love the work It's not like they just love the payout, because you get a lot of people that want to join private equity because it can be pretty lucrative. But like the stuff we do is I think it is the coolest job ever. I jokingly say that I would do there were parts of my job I would do for free, and probably some parts I would actually pay people to do because it's so fun and interesting. I love solving the challenges of businesses and how to transform a business and make it more valuable. Like I would do that stuff for free. So when we hire people in the space side and into the management companies, we want people that want to be there because they're excited about the work, not just about getting paid really well to do the work. So I think enthusiasm quotient is a good fifth thing. And then, it's a question of how do you take those people that fit the hiring criteria and how do you put them together on a team? Because we do all have different personalities in terms of like what's important to us and how we think. And, some of us are more analytical, some of us are more intuitive, some of us are more extroverted, some of us are more introverted. And we think a lot about, those sorts of things, and doing those sorts of assessments and how teams can come together and be the highest performing team, as a group. And, essentially it's the synergy of the psychological profiles where, 1 + 1 + 1 + 1 + 1 isn't, five individuals. It's like a score of 10 because you get the synergy of all those different skill sets and, different methodologies and thoughts coming together to come up with great solutions to challenging problems that improve the equity value of a portfolio company.
Wow, that was interesting. Um, so there's a lot of competition, but it doesn't sound like you run into a lot of competition getting in there. But how do you stay disciplined on price, purchase price?
Yeah. So it's bankers' jobs to investment bankers' jobs to try to drive the best price. And we say stay disciplined on price, just knowing our criteria for outcomes financially. And usually that dictates, it's pretty easy to dictate staying disciplined on the price to achieve the desired outcomes that we're telling our investors, what we're trying to deliver for them in terms of multiples of invested capital or IRR. So that drives a lot of it. And then just staying in contact with the industry and knowing where things are trading is pretty valuable as well. And then understanding how the sorts of things that we'll buy that are, need structuring and transformation, how that discounts the entry multiple, and that all works, tends to work out pretty well. That combined with the fact that the reality is like, we have a pool of funds and we can be a little bit more selective and a little more disciplined and a little bit biased and patient, honestly, with the deals we do. So we're looking to do 2 to 3 deals a year at Speyside, and we probably see a couple hundred. And as a result, you can always, if somebody is like, oh, look, you gotta go above your asking price, our view is, we'll just stay patient and, not do the deal. And a lot of times, we've seen a lot of deals that we like to call them boomerang deals where an investment banker will tell us, you got to offer this price to get the deal done. And, we say, we know it's going to trade here when it's all said and done and we're not moving. And then they'll tell us that, sorry, you're out of the process. And then 2 to 3 months later, it will boomerang back. They'll call you and tell you, hey, look, are you still willing to buy this business at the price you offered? And sometimes we are, sometimes we aren't, but a lot of times those come back. And the reality of private equity is kind of funny, like how the industry works. And at least I think it's a little bit funny because investment bankers are a lot like real estate agents, where they'll tell somebody their house or their business is worth more than it really is, so that they get the deal.
Yeah.
But then they need to come up with ways or reasons to explain to the seller why the business is not, or the business isn't trading at where they said initially they were going to be able to sell it at. So usually, my rule of thumb is when any banker tells you a business is worth a certain multiple, usually subtract two to three from that multiple, and that's probably where it ends up trading out.
Interesting. All right. Um, we're going to be wrapping up here, so I'm going to go to rapid fire, but I have one quick question for you. Um, what advice would you give to the manufacturers out there and companies out there with leadership that's betwixt? They're in the middle of whether I do it or I don't do it. What advice would you give for them that um, to help them stay on and move the company to the next level? And what advice would you give them if they wanted to um, go into the sell mode?
Yeah, so I think going into the sell mode, there's two things there. Number one is there are a lot of things you can do to prepare a business for exit, such that you can generate the best value on exit. Some of those things are like make sure you have a good management team, make sure you don't have concentration risk in your revenue portfolio, make sure the business is scalable as a platform, i.e., it has good processes such that if the next buyer wants to do acquisitions, those are pretty easy to integrate. Make sure your house is in order, I guess I would say, like all the legal and tax and those sorts of things are done and dusted, and that's not going to trip you up in due diligence and cause a purchase price reduction while the buyer is doing due diligence. So the short answer is you should be preparing for exit 12 to 18 months ahead of time, and making sure that to make sure that you get the greatest value for your business. Um, the other thing is, I would say, when you get into the process, just understand it's a little bit laborious because it's going to take 3 to 6 months, and buyers are going to ask for a lot of things in terms of data and then access to the company. So just get prepared that it can be frustrating at times.
It can be a little weird because as you come in and you are looking at somebody's books, asking questions, it's like looking under someone's dress. They
Yeah,
don't
for
like it.
sure.
So, would you recommend in this situation? And again, we're staying with the person that is selling. I suppose everybody should do all the things you said anyway, right? They should be checking themselves and looking at that. If the concentration's wrong, management's wrong, that stuff should be self-scouting. But would you recommend? I have a buddy of mine that does M&A where he helps companies prepare for uh, selling. Is that a good thing for you as the buyer to have somebody like they're almost like a broker? Is that or are they getting away?
Um, no, if you asked me this question 15 years ago, probably I would have answered this differently, which would have been that I don't love investment bankers. Now, what I would tell you is investment bankers and brokers are actually really quite valuable. And the reason why, or at least good ones are, and the reason why I think that's true is that good investment bankers are like, so I don't know this for a fact because I've been married to the same woman for 27 years, but like I would say they're like great marriage counselors. And the reason why I say that is, okay, when you strike the deal to start with, you and the seller are at the same point. You think there's the same value, and because you're working from the same set of facts. And what happens over the 3 to 6 month deal process is there are going to be times where you move apart in your views of the world. And what great bankers do is they bring you back together. And so you kind of think of like a helix, like think of like DNA, but
Yep.
turned horizontally. So what you see is like this going on over time, right?
Yeah.
And great bankers are great at bringing the parties back together and finding equilibrium in the deal. So my view, my humble personal opinion is like a good banker is worth their weight in gold for both the buyer and the seller. And a lot of time, my one buddy, he used to joke around about bankers is that, they're not loyal to the buyer, they're not loyal to the seller, they're just loyal to the deal. And that used to be kind of a pejorative comment, or you think about that as pejorative, but it's actually not. It's what both of you want as the buyer and seller,
Hmm.
because that person, that banker, is trying to bring you guys together to get a deal done, right? Just like a marriage counselor would, try to bring people together to stay married. But as a result, it's worth it if you can find a banker that can do that. And like, look, the seller is going to frustrate the buyer at some point. The buyer is going to frustrate the seller at some point. And you gotta work through the banker, both of you, to get a good deal done. And that banker will help that seller create value too, especially if they get them engaged a little bit early and talk to them about, hey, what are things that we can do that will make this
Take care of the
business more
company. Yeah.
palatable to a buyer.
Yeah. A little prettier, a little more lipstick on the pig.
Or fatter hams, as it will
Yeah,
be.
there you go. So, what excites you most about? We're going to get into the future and rapid fire here because we got to wrap this up. What excites you most about the industrial manufacturing space right now?
Yeah, the short answer is I think you're going to see more reshoring, onshoring, and nearshoring back into North America over the next 5 to 10 years. And I think that's going to be facilitated by robotics, AI, factory automation, machine learning, and all the Industry 4.0 tools that are out there.
You are an awesome interview because you keep walking right into my questions. AI and how's that impacting business for you? What's your forecast? What do you think about it? Um, what's your opinion, I suppose?
Yeah, so the short answer is I think a lot of manufacturing is going to come back to North America for various reasons. And we do not have the demographics in Canada and the US to support manufacturing the way that we used to manufacture 20 or 30 years ago when that stuff moved offshore. The upshot of all that is we're going to need AI, factory automation, machine learning, robotics, all that stuff to make up for the delta of the demographics. So, what I think you'll see is instead of people doing more hands-on manufacturing, you'll see them spending more time in manufacturing plants maintaining the assets, the robots, the AI, et cetera, that is actually doing the hands-on manufacturing going forward. So it's going to be a complete shift, but I don't know. I'm I love the United States of America. I think we're not perfect, but I think we're one of the best countries in the history of the world. And one of the things that has made us awesome over our 250-year life is number one, we've been great at the things that grow GDP, and those two big input variables are A, population, and B, innovation, or being more efficient with the same or less resource. And this country's been built on the backs of waves of immigration. I think that's going to continue. We just need to be smart about immigration and welcome, good, hardworking people into this country with open arms. And then I think we need to facilitate all of that with more innovation around being more efficient and getting more work out of not just, people helping them, but also just investing in those assets that allow everything to be more efficient, whether it's manufacturing plants or kiosks at McDonald's or whatever it happens to be. So I think it's a bright future for US and Canada and Mexico in terms of, probably in the future going back to being the world's manufacturing shop floor.
You know. Well, thank you for answering my next question already. Um, the interesting thing, though, just an opinion on my side, not that not anybody wants to hear from me, that corridor between Texas and us in the Midwest is huge, and I think you're going to see a resurgence. Everything from Detroit, Milwaukee, Chicago down through your Kansas cities and Oklahoma cities, and that just going to be big reshoring there. And I'd love to see the renaissance of Detroit would be just huge.
Yeah, and so just to comment on that, I 100% agree with what you're saying. And this is going to be a comment where, it kind of goes into the bucket of a broken watch is right twice a day.
Right.
So I've been saying for 30 years that manufacturing was going to come back to the Midwest. And now I think you're really going to see it. Here's why, though, that there's an argument there. The argument of why it's going to come back to the Midwest, it goes to infrastructure. So if you think about electricity, you think about water and wastewater, you think about get natural gas, you think about rail spurs, you think about navigable waterways, you think about roadways, all that.
Food.
Here's the reality of here's the reality of manufacturing. When you start up a manufacturing plant, a lot of times the real expense is not in the building. It's not putting up the four walls and the roof and the foundation. It's getting all the services that need to come to the manufacturing plant, the things I
Right.
just noticed, whether it's electricity, water, gas, or, transportation. The reality of the Midwest is all that infrastructure already exists. So what's true is it's way cheaper to refurbish plants in the Midwest than it is to build new plants somewhere else in the country. So I believe that, to your point, manufacturing absolutely is going to come back to the Midwest over the next 5 to 10 years. Now, what's interesting, if you want to go test my hypothesis, uh, go look at the industrial real estate transactions that have occurred in the Midwest over the last 3 years. So smart money is moving into industrial real estate in the Midwest because they all know what I just said.
Oh, it's just stunning what's happening between Chicago and Milwaukee. It's going to be a new town called Milwaukee. Um,
Yes.
it's just amazing. What used to be farm fields are now just unbelievable. So, all right, some rapid fire questions. I got to wrap this up. Biggest operational mistake a CEO that you now know could help others avoid. Biggest mistakes you've made as a CEO, and how could you help others
Oh,
avoid it?
hubris. Check yourself from time to time of whether you really think what's going on is going on, and be very self-critical.
One metric to judge an industrial business.
Um, EBITDA margin.
Manufacturing trend that worries you.
Uh, um, I guess I would say ICE visits.
Yeah, you caught me on that one. Yeah, I guess so. Wow. All right. We've got to wrap this up. Eric Wicklund, Managing Director at Speyside Equity. Thank you very much for joining us. That was awesome. Where can people find you and learn more about Speyside?
Yeah, if you just go to spaceoutequity.com, my information is listed there, and also can find me on LinkedIn if you want to connect. And chat further. Happy to do so.
Well, then let's get your name spelled right. It's Ericwicklndt.
That is correct, sir.
How do I say your last name so they know?
It is Wick Lent. Wick is in candle wick. Lent is in deny yourself for 40 days and 40 nights.
Ah, okay. Well, thank you for joining us. Appreciate it. It was